I would like it to be interactive, though. It's much more fun for us if it's a dialogue. So feel free to jump in, raise your hand. Having worked in practice in Washington for a very long time, I have a tendency to talk in Washington speak of acronyms. So if I do that and I mention something that you're not following me with, please, jump in. It's sort of that bad Washington habit. So I'll try and refrain as best I can. There we go. So as was mentioned, I'm going to cover some of the international issues. Mine tend to be focused more on the regulatory framework, but they really range. And if you think about it, when you're dealing overseas and internationally, it's much of this based on policy, trade policy, right? So the U.S. decides what we like, who we don't like, and laws and regulations are kind of framed around that, whether it's protecting U.S. organizations from other entities from outside the U.S. or assisting U.S. organizations as they try to expand their activities internationally. There's sort of that give and take. You see an ebb and flow with any administration, and that certainly is true today. So what we're going to talk about just very briefly, because we could spend a whole day on this topic and really diving into the weeds, but if there are certain issues that we talk about that you want more clarity on, feel free to raise your hand. A lot of it is, when you first think about it, we've seen the progression. Most organizations many years ago started as purely domestic, purely U.S. operations. And so when they were looking to expand internationally, part of the very regimen of what they were going to do is to figure out what form that would take. So we're going to talk about just briefly the form of your type of organization. If you're nascent in international activities, or if you're very robust and have a long history, we'll follow along there. It's also important to understand the foreign jurisdictions within which you're performing your activities or trying to move your goals forward, or just naturally interacting, because there's a lot of there are differences between and among the different jurisdictions. Oftentimes the trickiest part is finding the financial support, so following the money. Given that, as we all know, you only have to open the paper once to see that corruption these days is a very important issue. It's gotten much more complicated, much more globally robust in terms of both enforcement as well as in the coordination of those activities. We're going to talk about some other U.S. law considerations and restrictions that can happen that are kind of ancillary to what your main goal, what your projects and programs are. We'll talk about some ideas and tips for enhancing your compliance. I think most organizations have a set of practices and procedures already in place, whether they're written or not. I always like to say, if they're not written, then when you go to put them into writing, you're formalizing those policies and practices. And then we're going to talk about some real life examples, because honestly, you can't make this stuff up. Things that we've seen, experiences. So let's just jump in. There we go. So most of the organizations have had some path or history dealing overseas. Usually what we like to say is, what's the goal? What's the goal of your organization, your entity? What are you trying to achieve? Do you have a natural fit with an organization that already exists overseas, or are you going in, very first to establish something? My counsel has always been, you want to put your foot in the water before you dive in completely, because you have to become aware of just cultural issues, other challenges that may be there, and it's easy to do so by kind of taking a stepwise approach. And generally, with organizations with whom we've worked, that tends to be the path. Most boards of advisors and others, want to make sure that they feel comfortable at each stage. So, but ultimately, you want to make sure that your organization's goals are being met, and that can dictate different things for different organizations, right? So, an NGO that has, for example, a humanitarian, more of a grassroots goal and application could be very different than one that's more at a policy level, a state-to-state level. So, you'd approach those in two different manners. You also, one of the just kind of bottom line rules, it's easy to go into a new country or a new location, but it's not always easy to extricate yourself. So again, that's part of the reason of doing this stepwise approach, getting comfortable in the country barriers, other barriers, getting to understand who the players are, whether they're prospective partners, whether they're governmental organizations that you need to deal with. You know, it's like moving to a new city and finding a home. You know, usually most people will go and stay for a couple of weeks and kind of figure things out. Are you near the metro? Do you want to be in a high rise? So it's sort of that same thing. You need to kind of get your lay of the land, and that's a very important thing. The other thing is, you know, when you stand up an organization overseas, you're going to have to support that, right? And oftentimes it's the money that can be the most challenging to deal with. So whether you're required to set up a local bank account, whether the organization is independent of your entity here in the U.S., whether you have to have a certain percentage of local participation and ownership, all of those are important factors that you want to think about. And then it's just so taking a step back and saying, okay, in order to accomplish what we hope to accomplish, are you going to need educational materials? Are you going to be putting on conferences? Are you going to be coordinating with government organizations? Are you on more of the advocacy side? You know, so those are things too where there will be other entities and other personnel that will be involved that can either benefit what you're trying to do or complicate what you're trying to do.
Lindsay, this is Friedemann. May I add a little bit to color to your analogy of moving into and out of a city?
Please.
So I think Lindsay makes an incredibly important point for when NGOs are thinking about, you know, going into other jurisdictions with respect to there's a cost and an effort involved in setting up a partnership or some form of activities in the country. That's one part of the equation, and then lots of NGOs are thinking about this piece very closely, and there's a lot of analysis being done. But moving out, so to speak, is much more easy to move and to order a truck to start moving the furniture out. That's unfortunately not the case with respect to shutting down activities in many jurisdictions. And in my experience, especially in jurisdictions that are more on the developing side of things, whether it's South America or some African jurisdictions, shutting down an entity or an organization can take years. So my experience, for example, in Brazil is if you like to get out of Brazil, you're looking at a 3 to 4 year runway, which will dwarf the cost that it took to get into Brazil. So kind of like to emphasize Lindsay's point, it's really, I think the best way to go about this is really put your foot into the jurisdiction before you really commit to it, because there's a real expense to that.
Yeah, thank you, Friedemann. And the other point to make is a lot of times people will adopt a hub and spoke approach where, you know, if you're targeting a particular area of the world, there may be some countries where it's slightly easier, a little more flexible. And so you can use that as your hub base and then radiate out from there, because, you know, as we both have noted, it's very easy to get in, but it's very hard to get out of a particular location. So these are just up on the board, just some of the ideas and some thoughts and things that we've seen in the past. Again, one of the tricky ones is how to transfer the funds in order to support your activity in a particular location. So usually that's, you know, before you even do anything, you want to figure that out. And then oftentimes you can, you know, either adopt that hub and spoke approach or ensure that the funds that you're getting, either generating them from a local base, which is often quite difficult, or having support from, you know, the home operations is important. Okay, so you know, certainly in the world of corruption, as we say, not all countries are equal, and this is oftentimes referred to as the Transparency International heat map. And so you can see there are varying shades from, you know, a light yellow up to a deep dark red. Generally, Denmark usually ranks on top as the least corrupt. Oftentimes Nigeria comes out with the deepest and darkest of colors, excuse me, and the heat map. But that's not to say you can look at the United States and it's certainly not a pale yellow. It tends to rank around 17 or 19, from the top, but certainly not in the 1 or 2 spots. Some folks will say, well, that's because of activity in New Jersey. I don't know. I'm not from New Jersey. It's just, a comment that people make. Or the U.S. has some own internal corruption issues that they need to deal with. And so, when you're approaching corruption, the rest of the world, frankly, looks at the United States and says, well, you've had this law in place, and you're trying to impose your law on everyone else. Well, the time has changed a bit in that regard, where given some developments overseas, the OECD, for one, has implemented this multilateral agreement where other countries now impose as their own national legislation anti-corruption laws as well. So it's Organization for Economic Development, Cooperation and Development, OECD. And so that's a multilateral organization. There were 38, back at the original signing, 38 countries all said we too shall agree to this level playing field of anti-corruption. And so each country would then adopt and implement their own national legislation. That was really a sea change, because our law had been in place since 1975 or 77, and really it was for a good 20 years where it was just the U.S. saying, thou shalt do this, thou shalt do that, and frankly the rest of the world was saying, why are you coming and imposing your laws on us? Well, things have certainly changed, and the notion now is to really, for the benefit of everyone, and certainly humanitarian organizations where the money didn't always trickle down, even in the most favorable of environments where there was funding and the like, got stuck at the top, and it didn't make it all the way down to support the good works of many NGOs. And so the idea with the FCPA, the Foreign Corrupt Practices Act, is to prohibit bribery of foreign governmental officials. And that's interesting because ours specifically is for foreign governmental officials. There's also another statute that you can't bribe from a commercial standpoint as well. But ours, the anti-corruption statute in itself is focused on foreign government officials. Other countries do not have that particular limitation. And what's interesting is it's now this global trend where you find that one country will start an investigation, but the activity, we live in a global society, so an activity may start in one place, but the impact is felt in multiple countries. And so you have oftentimes now multiple country jurisdiction investigations. An interesting footnote is most other countries like for the U.S. to go first because we have the largest and most expansive ability to get discovery, to get documentation and data. That is not true in other countries. So if there's an investigation that's commenced with, let's say, 3 different jurisdictions, oftentimes we'll say, well, U.S., you go first, find what you can find. And then, by the way, in the spirit of cooperation, if you wouldn't mind sharing that with us, that would be terrific. So that's oftentimes what you say. But the bribery provisions are part of the anti-corruption, the FCPA statute in and of itself. The other piece is under the Securities and Exchange Commission, so that's for public companies. But there's a specific books and records for public companies. Really, the meat of it, though, is in the anti-bribery provisions, which are enforced by the U.S. Department of Justice. And so you can see there that the regulation prohibits the paying, offering to pay, promising to pay, even if money never exchanged hands, money or anything of value with corrupt intent, either directly or indirectly, to a foreign government official, and we have that in quotes, or a political party official. And that's done for the purpose of influencing an act or a decision, causing the official to fail to take some action, or obtaining or retaining business. And again, I'm putting quote marks around that because that really business just means the goal of your organization. It's not commercial. It's not commercial business per se. in order to secure an improper advantage. So the important pieces of that, you know, the devil is always in the details, but the important pieces of that is that it's not just putting a big bag of money on somebody's desk, you know, on the Minister of Health and Human Services. It's not that. It can be anything. It can be some other offer, and we'll talk about this later. It can be, you know, the lavish dinners, etc. So it goes to money, but also anything of value, and anything of value is very broadly interpreted. With corrupt intent, okay, that's almost presumed in this day and age. The corrupt intent, people are like, well, if you're giving them something that's above and beyond normal business interactions, there's got to be a corrupt intent. That's kind of the prism that you're dealing with. I noted that foreign government official has quote marks around it because outside the United States, so many people with whom you deal would fall into the definition of foreign government official. It's not just the minister, it's not the person at the top. It could be a doctor in a state-run hospital. They have been, you know, determined to be a foreign government official. So it's the front line all the way up to, you know, the top tier. It also is political party officials. Again, overseas, you often see people wearing multiple hats. They may be the Minister of Health. They may also be president of a company. It can be very confusing, you know, with whom you're dealing and in what capacity. You certainly want to get clarity on those points. And then the last bit of it is kind of for influencing a decision. At the end of the day, if there's an investigation, it can just drain the resources of the company, even if when all is said and done, you know, they don't bring charges against the organization. Just going through the process is multi-year, completely disruptive, and really takes away from what you're trying to achieve on a day-to-day basis. So, you know, I think that certainly the biggest challenge these days falls within kind of this anti-corruption area for organizations doing business overseas. So it's not to be taken lightly. The other interesting point from when you compare the U.S. versus other programs is that we have an exception for grease payments, where other countries do not allow that, and it's called grease payment. So it's in theory, it's a ministerial amount to permit a non-discretionary act. So let's say, for example, I'm going to go overseas, you know, next week. My passport's running out, and I need it, you know, I need a renewal in 2 days. So I can pay an extra fee to get my passport renewed. In theory, that was the thinking behind grease payment. No other country has a grease payment exception. When the OECD and others are looking at anti-corruption and giving it kind of a grade for all countries, this is like the biggest mark that they hate. Everybody around the globe says we don't like grease payments. It's kind of a slippery slope. It's not defined monetarily. So that's really, you know, it's a challenge, and most organizations adopt a policy not to permit grease payments just because of that kind of gray zone and potential area for trouble. The other note there is that certain affirmative defenses do exist. So one would be, for example, if it is written in the law of the foreign country that what your activity is permitted, then it doesn't, it's not a breach of the FCPA. Okay, so I've been doing this 30 years. I have yet to see any country law say you can bribe our officials. Come on in. So again, the affirmative defense is sort of useless, frankly. Okay, so if you look at it, you know, this is also known as kind of the follow the money and other things of value. The applicability of it, though, is that, thinking back to that heat map, not all countries are created equal in terms of your risk, and most organizations want to approach this on a risk basis because you tend to have limited resources and time, et cetera. So you think, okay, where's our greatest point of risk? And then work your way down to, you know, to the lowest point of risk for, in theory, 100% compliance. So you really would want to start by thinking, where are we interacting? Which countries? With whom are we interacting in those countries? You know, are we dealing on a regular basis with different government officials at whatever level, from the minister on down? do we have a relationship with others overseas who are our agents, who are acting on our behalf, and do we have clear vision as to what they're doing? These laws are strict liability, meaning, really the intent is you can trip over it, so that if you engage someone, you say, well, we've hired them as our agent to do our due diligence, to be our, ears and eyes on the ground. Well, that brings the liability for your organization, back in the United States, because having them operate as your agent means you have supervision and control over them. So if they do something, that they shouldn't, even if you're not fully aware of it, in theory, that liability is imputed to you. So one of the biggest areas of risk that we see is, usually we'd rank them by be careful of the countries and look more carefully at, Denmark I'd put lower on the list than some other countries, and generally where the humanitarian need is in areas that have conflicts and have generally longer histories of, this is the way we do business. You have to bring some backsheesh, it's just kind of the way that things have developed. But the other area of risk that we see is when you're dealing with others on your behalf overseas. So, notwithstanding the fact that I said you want to tip your toe in the water before you jump in completely, but you also have to be careful of the folks and the organizations that you're doing business with over there because of this risk factor. And you really want to do your due diligence for purposes of engagement. Okay, some of the other national, international anti-bribery laws that I mentioned, a lot of local laws now in places that you wouldn't necessarily think of. China, Brazil, you hear and read about, instances or allegations of corruption in these other countries, but they're just as quick to say, well, we're going to look at what's happening here in our own backyard. So under their own national laws, they can bring organizations such as yours into an investigation of their own, separate and apart from the U.S. UK Bribery Act specifically includes commercial bribery. The act doesn't have to have occurred in the UK, but if there's some nexus, if you basically have a person in the phone in the UK, they'll be like, me too, we might have a case here, even though the alleged bribery may have occurred in a country in Africa, for example. And then the OECD, as I mentioned, has the international recognition and implementation throughout its member states. Okay, so other U.S. law considerations when you're dealing overseas, obviously accurate recording and reporting. So even though you're not technically subject to the SEC rules, it does follow that maintaining control over your books and records, certainly for your activities in the U.S., but equally for your activities overseas, and not having just kind of like the miscellaneous fund or the slush fund or it's just too complicated, so we just throw 10 grand in there and let the locals figure it out. Like, no, that's the problem. And then you also have to think about there can be reporting requirements for multiple government agencies and entities. So not only, for example, when you're traveling back into the U.S., just as most everyone is aware, you've got to fill out the form or now fill it out online at the kiosk in Dulles about reporting whether you're bringing in $10,000 or more. So there are treasury concerns, you're reporting to customs, etc. The anti-money laundering considerations, that's something that also dovetails with this as well. So know your customer, sort of, that's kind of the umbrella phrase, but it really means know everyone that you're dealing with, whether it's a service provider, whether it's one of your banks overseas, whether it's your agent, whoever it is, be sure that you know who they are and what they're doing for you. There are also anti-boycott reporting requirements. If you get a request for somebody overseas that says, well, whatever you do, you can't use this bank. Even if you don't use that particular bank, the request itself triggers an obligation for U.S. persons and organizations to report that. So, and there's reporting requirements to both Commerce and the IRS. So, a lot of people aren't aware of that. They say, well, we didn't follow it. We couldn't, deal with this bank or this entity. We didn't follow that, but they don't then take that next step
you clarify that?
Sure.
It's a rule that the local country is making that you can't deal with a particular entity, or it's a rule that the U.S. government is making that we need to follow?
Right. Okay. Good
or
question.
is something that we're not supposed to?
So it stems predominantly from the anti-Arab boycott of Israel. So you see that oftentimes where they say, we want to do business with you. We want you to help us in our humanitarian organizations. We want you to, we need some certain funding support, but whatever you do, don't use this bank, right? And they'll designate, you know, Bank of Israel, Bank of whatever. That request to not use that particular bank is what is reported, right? That's the genesis of the anti-boycott, but they've stemmed so that they're much greater now. So if anyone says, don't use X, take a look at it, think about it and figure out why are they asking you that? Is it an anti-boycott request, or is it a, you know, or is it a commercial decision? Does that make sense?
Yeah.
And then the reporting to customs, you know, you want to think about how your programs are being funded and how you're either paying or receiving funds. We've seen many instances where it's challenging to get funds into some war-torn areas where, you know, in order to support the activities in these places, you can't just walk in and, hi, I'm you know, Lindsay Meyer, and I want to set up a bank account. It just doesn't work that way. And there's also challenges to, you know, literally carrying in the money from a security standpoint. So, you know, you've got to be mindful of that. But likewise, it's also ones where we've seen that supporting the locals, they say, well, it would really be better if you just give them cash. Okay, that can be very problematic for a lot of reasons. So you have to understand and balance the practical difficulties that you're facing, as well as some of the requirements that you need to also, as an organization and as a U.S. person or person in the U.S., you need to follow. So we've seen some instances where people are like, well, we know we can't bring in 10 grand, so you take 5, you take 3, you take 3, and we're good to go. You know, again, it's you can't do indirectly what you should do directly. So the customs is not so fond of that. And then, you know, you would technically be coming in having more than $10,000 for your organization or entity. So it's not like, well, Joe had 5 and Sally had 3. It's sort of the accumulation. So then making the statement to customers, no, we're not carrying more than 10 grand, can be asserted as a false statement. So believe it or not, we've had these issues come up. Some other U.S. law considerations. Excuse me. So everyone today, certainly here in Washington and frankly around the U.S., familiar with our sanctions programs. One just got added this morning. I was driving in, listening to NPR, and you know we've got another one on the list, South America. The U.S. sanctions programs have been in effect for many, many years, and historically, the complete embargo has been really on the 5 Iran, Syria, also known as IRIA, apparently, Iran, Syria, Cuba, Sudan, North Korea. Those have been ones where it's been sort of a blanket, thou shalt not. If you're a U.S. person, a U.S. organization, a person in the United States, even if, let's say I was a French citizen, but because I'm sitting here in this lovely conference room, I'm here in U.S. soil, the jurisdiction attached. So if an activity then, if I say, well, if I were back in France, I could transact business with, you know, the Minister of Health in Iran. Why can't we do it here? Because the U.S. soil is attached. So the sanctions are both large, comprehensive embargoes, such as those countries, as well as more targeted. And the trend lately has to implement more targeted sanctions, and that was probably best exemplified with the Crimea sanctions, where, you know, the activities that occurred in Ukraine and Crimea section, they were targeting certain persons and organizations that were owned by certain persons. And so rather than having a thou shalt not, it was, you can't do business with this individual provided you're doing, X, Y, or Z activity. So it wasn't a complete can't do business. It was you can't do business if you're drilling oil or you're supporting their activities to drill oil or you're using financial services that they're providing. Those, I have to tell you, are much more challenging to regulate and to comply with than just the thou shalt not, frankly. So when you're dealing with these targeted sanctions, it's a list of individuals, it can be a president of a country, it can be an organization, it can be a bank, it can be an insurance company, it can be, you name it, it can be a trafficker, whatever. And the list is constantly updated, constantly changing. So it's something that you really, you go back to think carefully about with whom you're dealing overseas, and this is one of the reasons why.
And Lindsay, what's the kind of practical implication for kind of all the NGOs represented here in terms of what do they need to be doing on a regular basis before you contract with a certain company or checking out who owns that company, or for to be a vendor, to be a subrecipient, a subcontractor, whatever the case is.
So the very first thing you'd want to do is gather up all the names of the folks that you're dealing with, whether it's individuals or if it's an organization. What I suggest is get the proper name, the full legal name of the organization. I would also include probably the president or whoever the head of that organization is, and then you'd want to screen them. There's a free, I don't know if I have it in here, but we certainly can provide it. The government has consolidated. There are actually like 9 different lists that you have to make sure you're checking. The government has now, the last couple of years, developed a consolidated list. Easier. So you'd run those names through the list. You may get some false positives, you may get some hits, and then you have to do kind of the next step of, is it a false positive, meaning the name is similar, but it's not identical, which you call, a false positive. You do a little due diligence, say, okay, well, the Snow Apple Company, not the Snow Peach Company, the address is different, you put a little note file, off you go. So you certainly want to screen the people that you're dealing with, and that can be challenging, and certainly, does that mean you have let's say you've opened an office in a particular country, you're doing business with 3 main organizations in that country, but let's say you've got a cleaning service that comes through and helps you out. Does that mean you've got to screen the cleaning service? Does that mean you have to deal with every person? And here it's sort of, again, that risk-based analysis. You have to think about where's your risk, what's the likelihood. Now, if the cleaning service was like one of 500, cornered the market in that whole country, then I'd say maybe yes. But if it's just someone that you've engaged for normal activities and the payments are satisfactory, then for the most part you wouldn't need to screen down to the very last person. So again, if you think about it, you want to take a practical approach to that. But it is, again, strict liability. So if you find that you're dealing with somebody who is on the list or becomes on the list, is added to the list, then as a U.S. organization, you're prohibited from dealing with them. And if you ignore it, and there have been some instances where organizations have ignored it, said, well, we're not subject to your laws, or we're only operating through our parent company in another country. The ultimate stick that the government has is that they can then add you to the list, and then suddenly every other U.S. organization, person in the U.S. can no longer deal with you. So that's a pretty big, shutting down your business, shutting down your operations.
And Lindsay, I would also presume that to the extent that folks here have overseas offices that are the ones oftentimes entering into contracts and vendor relationships, subrecipient, subcontracting relationships, that proper training of all of your relevant staff and contractors on these things is critical, because your organization is ultimately liable for everything that happens. And that's where we often see many of the breakdowns in this area. It's not with kind of the more sophisticated headquarters staff like you guys who are well aware of these things, but it's out in the field, and it's with the frontline program staff and whatnot. And that's where training on a regular basis is really critical to make it as easy as possible, like Lindsay said, balance the risk versus the reward, but have having kind of a robust, regular, comprehensive training program, not just on economic sanctions, but on broader compliance issues, is so critical.
That's right. And what you want to do is oftentimes we'll find that a policy will be driven from, your headquarters, with procedures that implement, because there might be variances, depending upon the way you're operating in different countries or different locations. So you can appreciate that there has to be, some flexibility or understanding. But what we always say is we want to provide you with your first line of defense, so that if something happens in some office, you can say, well, that was a rogue activity. It's contrary to what we have stated as our procedures, what we've identified as our compliance baseline. And that then gives you kind of the starting point to certainly either mitigate or minimize any penalties that could be assessed.
And the same thing, by the way, sorry to interrupt, applies with respect to compliance with federal grant and cooperative agreement requirements. And what I'm sure we're all seeing of some of the more recent abuses that have been publicized by the like USA Inspector General's office. And again, a lot of the stuff that happened with the folks out in the field, sometimes the employees, but remote employees out in the field, and sometimes contractors and subrecipients who are engaged in hiring other folks. And to the extent that organizations have kind of a robust training programming, you can say, whether it's to the agency itself or to the IG's office, look, it's basically a rogue employee or a rogue contractor. Look at all the things that we did prophylactically to try to prevent this, and this isn't part of our culture, and it's not part of our norms, and it's basically someone who kind of went off script and off the grid and did things that weren't supposed to. It'll really go a huge way toward minimizing your liability. Whereas when those IG investigators or anyone else, but when they look at it and they see you don't have any of these kind of compliance protocols in place, they take a very different posture to the whole organization.
Yeah, that's true. And what you can find, like I use the phrase of, your first line of defense, but what you can then do is, if in fact you've got that baseline in place, you can then often isolate. There have been cases where the government, whether it's IG or DOJ or whomever, they'll acknowledge that you do have kind of the base principles, you train on them, you bring whenever there's like a natural time to bring folks together by webinar, by whatever, then you can oftentimes just isolate it down to just either that location or that region, because that's the whole, obviously the name of the game is you don't want to then have an investigation of all of your global activities undertaken. So, and that has been successful. I'll just touch upon just very briefly export controls too, as you're either sending equipment out into the field or support services. Back in the day, these satellite phones were a regular thing. Satellite phones were controlled for export purposes, and even though the folks who were needing them were going to obviously remote and dangerous locations, they still needed to get export control licenses from the government, so the government could understand what was going where and that it's maintained, it was maintained within your control. So there can be things. Now it's a little different today, where frankly, in your pocket or purse, you've got effectively a mini computer in your phone, but still there can be types of equipment that you need to support your activities remotely. So you want to give some thought to that as well. Foreign law considerations, you want to know the restrictions locally. So really now I've just been talking predominantly about the U.S. view and vision of restrictions, but there can also, and oftentimes are, local restrictions that can apply as well. Foreign controls, currency flow. So again, it's like, you can always get in and do operations in a country, it's hard to get out. Same thing with the money. So oftentimes organizations will manage and really try and limit the amount of funds that go in that are needed for the local operations, but not just put in so much that they can't then retract them as needed. There could be prohibitions on hard currency movement, collection of duties, dues, revenues, etc. Some other investment concerns, understanding kind of what the requirements are. If you're going to go in a more formal basis, there can be certain levels of requirements and foreign investment that's required. You also may want to think about, this is sort of around the fringes, but is what you're trying to achieve going to run smack into some national policy consideration? That doesn't mean you're going to stop, but you want to go in with eyes wide open on that and understand where are your allies, who's going to be your resistance, because you may find yourself under greater scrutiny than if it's some initiative that's consistent with the local government wants to achieve, right? Okay, and then as we talked about before, whenever we think about compliance considerations, I always think about them from two perspectives. The regulatory perspective is those imposed by the government, and contractual are those when you're dealing with your service providers and others. So you want to make sure that you're in compliance with both the regulatory piece of it, be it U.S. or international, as well as kind of contractual provisions. That, you know, if you've got, this goes back to your baseline of what you will require, if you know, as a U.S. organization, you've got these requirements that apply to you. So if you're hiring or engaging or contracting with a local representative, they know that they too will now be subject to these, because by virtue of extension, you know, you're the principal, they're your agents. You want to push them down and make sure in writing that that's clarified.
And of course, also always be certain to look closely at your own kind of federal grant agreement or cooperative agreement to look at what specific requirements beyond kind of the general regulatory requirements that apply to federal award recipients, like the uniform guidance, looking at what specifically is required.
A lot of flow down.
Yeah,
a lot of flow down.
Provisions that have to be included in sub-recipient agreements and subcontracts.
Right. And then just at the end, I have got a couple, you know, sticky provisions: dispute resolution, governing law, et cetera, et cetera. So those are just some things to think about as you're dealing with others. And I get that to work. Okay. So some of the examples that we've seen have been requests to over invoice. Okay, we know that we agreed that, you know, you'd pay me $10,000 for the service I'm providing, but you know what? It would be better if you could invoice me for $12,000, even though you really only paid me for 10. Like, no, that's a no. Because really what they're trying to do there is to either evade local tax obligations, put some money in their pocket, who knows what. So the over invoicing or double invoicing, they're like, okay, well, we use this one to report to the government, but this is the one, wink, wink, that we're really going to have between us. No double, no side invoicing. Similarly, you want to make sure that your local representatives, you have the ability to audit their books. You know, again, that's kind of a contractual obligation, but it helps support you to make sure that they're not running two sets of books. Again, we've seen a little bit of everything here. So, you know, as you sit here today, you go, well, surely that can't be true. It's true. It's true. Request to pay outside of the country within which you're doing business. They say, that's great. Yeah, thanks. Here's my invoice. But if you wouldn't mind, throw it over to my account in the team. No, thank you. No. Those requests to pay a middleman, you know, anything that it's sort of that gut check when it comes to the money. Just if it doesn't feel right, it doesn't smell right, it doesn't taste right, you know, you want to take a really close look at that. And having the ability within any agreement when you're engaging with someone to, number one, audit their activities on a regular basis, and number two, use that as an opportunity of breach so that you can then properly terminate their relationship without finding yourself in some employment or labor law hot water. Avoid the cash mule. That's what I talked about before. You know, well, it's really, we don't have a bank account there, so when Sally goes over next time, just, you know, have her bring some cash or have her bring some other currency, you know, convert it and on your way through or whatever. No, none of that. And unfortunately, because people find it there's so much red tape in getting money in and out and getting money to folks who need it, that they often resort to these workarounds. So you really have to educate folks, and you know, they're trying to do good, they're trying to advance the mission and the goals, but it ends up creating a greater liability than you certainly want. And then for any of these too, when an issue arises, you want to talk to your lawyers to say, okay, number one, do we have an obligation to disclose something? number two, if we don't have an obligation, have we taken corrective action? I mean, there's a whole strategy behind that, but you want to talk to your lawyer so you at least have the sake of privilege behind the discussion, right? So you can make more of an educated and strategic plan as to how you're best going to, even if you do go in and disclose it, how you're going to bring it to closure. We've worked with several organizations who have had that, have had the entity overseas kind of go off course, and the organization, obviously, if you think about it, you know, you get a lot of, oftentimes, NGOs get a lot of funding and grants, so you don't want to lose that pipeline. And if the government or whoever is giving it to you just trust what you're doing or feel that you're not, you know, living up to your obligations, you know, then the golden goose is no longer.
Yeah, and we're not suggesting that you don't disclose, you know, fraud and abuse and wrongdoing when you discover it, but when and how you disclose it is critical. And despite protestations to the contrary sometimes from some U.S. agency, IG officials and whatnot, that you should disclose everything immediately and come straight to them and don't go to your lawyers. When Lindsay refers to privilege, she's referring to the attorney-client privilege. And when you disclose something and consult your legal counsel for advice on what and how to deal with an issue and how to deal with a disclosure, that's protected, meaning that the government, private litigants in a lawsuit, or anyone else cannot get access to that information and that advice. Whereas if you're sharing that information with other third parties outside your organization, that is no longer protected by the attorney-client privilege. It can be extremely beneficial to be able to talk through and think through and strategize with your counsel. Okay, what happened? Let's do some more due diligence. Let's figure out what happened. Where was the breakdown? Figure out how to disclose it. Perhaps, for instance, if you're going to disclose some sort of a bad act that occurred, but you want to package it up with a description of all of the great prophylactic things that you guys have tried to do to prevent that from happening, that's going to carry a lot more weight with the agency that you're disclosing it to, or whoever it might be, as opposed to just simply disclosing the fact of what occurred without giving that broader context. And so that's kind of the benefit of working through counsel in that regard. There are obligations, for federal grants and whatnot for prompt disclosure, and we're not at all suggesting that it not be prompt, but involving counsel can be critical. You have a question?
Yeah, on that note, because I'm going through this right now, looking at the regulations and sort of developing or revising our policy. So the regulations, the uniform, super circular, I mean, they state that any type of violation occurs, but if you look at the specific guidance from the agencies, they're using the term allegation, right? And so there's a discrepancy there.
Yeah.
And so obviously I don't want to disclose allegations because what if it's, not true and that kind of thing. So like, how do you balance that, the internal guidance that they're giving you and
Go ahead, first.
Okay. So, as with anything, when an issue or a potential issue arises, you have to do your due diligence, you have to do your fact finding, because you have to assess. So, that's, I would say, even an issue is before an allegation, right? And so you'd want to get the full scope of it, because if you also just drill down on one, you want to step back and go, okay, that person or that organization is also dealing over here, even though the particular issue, a potential issue, may just be in one specific location. So I think it's important in order to do that, and we often get called in for those hard ones because it's on a scale of things where there's strategy. We'd say, okay, there's a potential issue. Frankly, I would distinguish that from an allegation per se, because it hasn't risen to that level. You don't have sufficient facts. And then if it's then going to, a violation, that's even a, further step, because you've effectively affirmed there's been a breach.
Yeah, the bottom line is every case is different. If I were you, I would be reluctant to put in any written policy that is going to be, automatic instant disclosure to your federal granting agency or whatever right away. Every situation is different. Even in the kind of now publicized kind of procurement fraud that has occurred in Turkey in connection with kind of the Syrian refugee crisis, even there, if some of the organizations involved have been publicly criticized for not making full disclosure right away. But even if they had, they needed to understand the full scope of what was going on, drill down, what happened, who was involved, obviously taking immediate steps, for instance, to suspend access to your organization's, technology systems or money or bank, other things like that. But there is a proper and prompt way to go about it. But the bottom line is consulting with, your legal counsel who's experienced in this area. There's really no substitute for doing.
And that in and of itself is an action you turn to. You say, this potential issue arose. We were alerted to it through a hotline, through a whatever. We kind of froze the system. We called our counsel so that we could then investigate, figure out, is there true allegation? Is there a violation? And government agencies will appreciate that fact. This is not like an instance where you shoot first and aim second.
And there's a long established protocol for what we call lawyers call litigation holds, basically putting a freeze on anything. So no one can delete emails, people that are suspected of something don't have access. They put an administrative lead, frozen out of the system, things like that. All right, let's wrap this up so we can give freedom.
Yeah, so the last piece, I'm just saying, again, because of the environment we live in today, people are going on and off of these various lists. You may find that you've been dealing with somebody for a while, and suddenly they're on a list. So if they're a supporter of terrorism, there's a disconnect between organizations are only permitted to follow and support their charitable goals, which obviously would be inconsistent if you're dealing with somebody who's bound to be on one of these lists, and where their funds are then frozen as well, and you get kind of cross switches between IRS and the DOJ. So again, the bottom line theme is just know who you're dealing with and check periodically to ensure that they haven't been added to the list. So, Friedman, we're going to move forward now to the tax issues. Just let me know when I'm advanced.
He's going to
do it? Okay.
Yeah, thank you, Lindsay. And if it always amazes me when I have the pleasure to co-present with Lindsay about the wealth of information you have, but then also I think if you're the recipient of an NGO that is a transaction in more than just the U.S., it's a pretty scary environment, and so it's good to have you on board. It kind of like morphs with now when we talk about the tax issues. It seems like tax is almost easy. So let me shift gears, and I'm just trying to.
I've got you. Friedman, I can advance them for you.
Okay, if you could advance, thank you. Yeah. So what I like to talk about is really kind of like cross-border funds, and when you make funding of your organizations outside of the U.S., how does this really need to be reflected, and reported, and what do you have to be worried about on your returns in the U.S.? So maybe next page, please. So we basically have really a broad rule, and I think it's helpful for folks who are in charge of whether it's the treasury functions, whether it's other functions who make payments outside of the U.S. There are two rules that we should never forget. One is there are certain payments that are made from the U.S. that are subject to a withholding tax. And then almost all cross-border payments to your organizations outside of the U.S. are subject to a IRS documentation requirement. And that's just very critical to keep in mind. Lindsay, can you go to the next slide, please?
Which page? Sorry.
Just the cross-border payment.
Yeah, we're there.
Okay, so I guess so I trust you. My computer froze, of course.
Okay.
So there are certain payments that are potentially subject to a withholding tax, and they are also subject to a reporting requirement. And they are basically any types of interest that can be characterized as an interest. So, for example, if you were to fund your organization outside of the U.S. and the funding would be viewed as a loan, then any payments that are associated with that could be viewed as an interest. There's obviously dividends. There could be rents that could be implied, or kind of like royalty. So if you provide your NGO access to a software, that could be viewed as a royalty, and therefore it potentially could be subject to a withholding tax in the U.S. There are payments made to non-U.S. Organizations that are, if they are connected with a U.S. trade or business, again, they could be subject to a withholding tax. There are compensation to personnel, whether they're independent contractors or employees. Those are subject to a withholding tax, and they are subject to information reporting requirements, and of course then gifts and grants as well. So if we go to the next slide, you kind of like get, and I'm picking out those countries more as an example. You get a flavor on the impact of these payments to your organizations outside of the U.S. So if you are subject to a withholding tax rate, and what that means that any payment you make, it should be a 30% withholding tax, and that 30% needs to be submitted to the IRS. So if you think about this and you spend $100 in funding outside of the U.S., $70 will ultimately end up in the hands of the NGO, and $30 should be submitted to the IRS. So it's a pretty hefty impact. There are basically tax treaties in place between the United States and many foreign countries, which either reduce or entirely eliminate the 30% tax. And so I just put down a few countries like China, Germany, or Ireland, and you see that those could be nice reductions or eliminations. In order to get to that point, and in order to qualify, so to speak, for these benefits, your recipients of your payments, they have to certify that they actually do qualify for these benefits. There are forms that you have to collect, and then there is a certain due diligence process that need to be made. And then once that's being completed, then in the case the IRS were able to audit the NGO, then you have efficient evidence to show that a withholding tax would have not been applicable. In my experience, I do run across that issue quite a bit, that NGOs don't think about this implication, and so it only actually, quite frankly, surfaces once, or if books are being audited. So, and of course, then it's kind of like too late. So it's just, in my opinion, I go back to that general rule. Every time there's a payment made from the U.S. to a non-U.S. country or outside of the U.S., think about both things. Is it subject to a withholding tax? And even if it's not subject to a withholding tax, what reporting or what forms need to be collected? So the next page kind of like goes a little bit more into details about about the tax treaty, and then kind of like what are the qualifications or what are the limitations. And so I set out a few examples that apply, that one has to think through. Like, I mean, the one that I always like, and that's now less prevalent than it was a few years ago, that folks went basically treaty shopping. So they determined, or they realized that it would have been better for payment to be made in one country than another because they had a better a tax treaty with the U.S., but the substance, or what the actual action, was actually happening in the other place. And so the IRS came out with rules, and in conjunction with other taxing jurisdictions and kind of like undermine those strategies now. Speaking about these forms, and I'm setting out these forms on slide 19. These forms should be very, they should become familiar with. And what I mean with that, again, it goes back to that notion, if you make cross-border payments, any of those forms or some of those forms, and I will walk you through those, should be part and parcel to your toolkit. So, the first form, the W-8, and the various permutation of that form is really aimed to identify the recipient of your payment as somebody who is a non-U.S. person. So you have the W-9, which is for the U.S. person, and the W-8 for a non-U.S. person. But it also serves another purpose, that in case you're trying to avoid or limit your withholding tax obligation, that form needs to be collected for that reason as well. There are forms with respect to compensation of independent contractors, and that's something that's a hot topic right now, because I think there's a lots of NGOs that are characterizing certain folks as independent contractors in order to alleviate some of the employment considerations, as well as kind of like withholding tax obligations. It's a hot issue not only in the U.S. But also in many jurisdictions, because if you basically control the person and you more or less dictate what they are doing, a country would easily determine that even though you treat them formally as an independent contractor, they're really a de facto employee. And then once they're a de facto employee, it has implications with respect to your tax reporting, but then also it has an impact on the NGOs being viewed as doing activities, at the NGO in the U.S. being viewed as doing activities in that foreign country. So it's one of those critical points where if resources should be spent to really make sure that you have a good understanding and a good characterization about the folks who are doing work for you. The last item I'm going to point out here is the form 1042S, and it's really it comes often into play when we have NGOs who have either board members who don't live in the U.S. but they come here for board meetings, or many times folks who are really not connected with the U.S. but they come to the U.S. and they provide some service to the NGO in D.C. for a few weeks. This is kind of like a form and a topic that you need to be aware that in case a foreign person or non-U.S. person provides services in the U.S. is being compensated for those services, there is not only a tax liability for that person, but there's also a withholding or a reporting requirement to the IRS, and it's one of those. It's an easy thing to comply with because it's an annual reporting requirement. The penalties are tremendous if you don't do it. So it's kind of like it's a risk-benefit analysis, and I always say comply with the reporting because the risk it just outweighs any benefits if there were to be any. Moving on to the next page, kind of like.
Hold on, wait a minute. We have a question here from one of these.
Could you please maybe explain the difference again between forms W8BEN and 8BEN-E? I think if you look at those two forms, they are both kind of similar, and it could both be applicable to nonprofits. So if you go through all those requirements, and if you tick marks
Yeah, no, that's a very thank you for the question, and it's a very timely question. So the IRS, maybe 3 years ago, the world to complete these forms was much simpler. And these forms, I mean, much simpler. They were maybe 4 pages long, and the instructions to those forms were maybe 10 pages. So it was semi digestible. In connection with the IRS trying to get a better handle on information for folks who are having a cash outside of the US, these forms have been revised, and it's in conjunction with the FATCA regulations as well as the efforts by the OECD. And so when you look at these forms now, these forms, the form itself, the W8BNE, is about almost 30 pages long, and the instructions are basically you have to spend, I don't know, 50 hours to read them. So what are the differences between those two forms? So the W8BN is now used only to individuals, and the W8BNE is really utilized now for corporations that are treated as corporations in the U.S. And so there's a kind of like a different, focus and purpose for those two forms. Before the revisions, it only existed the W8BN. So in some sense, the analysis behind it is still very similar between an individual that is a non-U.S. person and that needs to submit the W8BN, and a corporation, or is treated as corporations under the IRS rules, which then needs to submit the form with the -E. But because of the new regulations that are now really tracing money more closely, the forms have become exceedingly complicated, and I spend actually lots of time advising clients how to complete those forms, and I give seminars on that. So I hope that answers the question, and I recognize we could probably spend 5 hours on those forms alone.
And I should say, wait, before you go on, Friedman, and we are going to need to wrap up, probably 15 minutes at most, but contact information for all of us is on the last slide. So if you have follow-up questions that we don't get to deal with today, feel free to reach out. And also, I should mention, and I apologize that weren't included here, but for many of you may know that we do monthly programs on different nonprofit legal issues at our firm, an in-person program with a live webinar component. And the program we did in June was all about independent contractors versus employees. Really good program. We record all of those with a video recording and have those on a nonprofit YouTube channel. And I'll be sure to send Princess you the link to that. So you can send that out. So if you guys want to get more information on that, or frankly on any of the other programs that we have on about every nonprofit legal topic imaginable, you can feel free to consult that resource. All right, sorry, Friedman.
No, that's quite all right. That's thanks, Jeff. So shifting gears slightly, bank accounts, and this goes back to also what Lindsay was talking about. How do you actually get money into cash into the outside of the U.S.? So there are really two regulations that you guys need to be made aware. It's one is the anti-money laundering regulations, the MAL, and then the KYC, the Know Your Customer requirements. These are both aimed to really trace money. That's really what they're aimed, and they're really also aimed to understand the source of funds, and banks have become under great scrutiny from various governmental agencies, including again the OECD, to ensure that whenever funds are being admitted, that it's not somehow funds that are unknown. And as a consequence, opening bank accounts now is outside of the U.S. It's a lengthy process, and so it kind of like, again, from a planning perspective, as you expand and you're thinking about having operations in outside of the U.S., it's very important to have a strategic approach to it, because when you need or when it's required to open bank accounts in these jurisdictions, you really need a runway of anywhere between 3 to 6 months in order to get through these know your customer and AML regulations. Just kind of like as intrusive, as an example, the KYC requirements are as intrusive as that they will require from individuals to provide a bill from PG&E on their electricity consumption, so that people can really trace that they are living somewhere. So it's a pretty onerous requirement, and it's just good to keep in mind. The other thing that has arisen over the last few years is the Common Reporting Standard, the CRS, and this is basically a system. Whereas most jurisdictions, with a few notable exceptions, have signed up on an agreement that basically now banks will have an automatic exchange of information of funds that are deposited in bank accounts. There's a certain irony to the CRS, what we are seeing right now, and it's obviously driven by the intent by the OECD and other taxing jurisdictions to avoid tax evasion. What is interesting about this is that the US is one of the few jurisdictions that has not signed up for the CRS, and as a consequence, we are seeing now, interesting enough, some funds actually flowing back from outside of the U.S. inside of the U.S., which is, I think, probably an unintended consequence. But for the NGOs operating outside of the U.S., it's critical that you understand that the CRS is in place, and kind of like to build on Lindsay's example about somebody asking the NGO to make a payment not in country but outside of the country, maybe even in a for a bank account that happens to be located in the U.S. Please think about CRS and maybe not recommend it. Shifting once more, kind of like gear, and this is more an example on how we deal with some of the tax issue that we run into for NGOs that are operating internationally. It's really kind of like the whole concept about how do you deal with employment, and how do you make sure that your valuable employees are getting the similar benefits that they are getting when they are in the U.S. And so one fact pattern that we see a lot is that an NGO has an employee in the U.S. They want to move overseas for a couple of years to build up the operation or the organization outside of the U.S., but they would like to maintain the same level of benefits they are getting in the U.S., which is only fair, whether it's medical insurance, whether it's the 401k, whether it's just kind of like not being disconnected from what they're used to in the U.S. And so one way we have dealt with that, and it's very successful, is really with so-called secondment arrangements, where you basically keep the employee on your U.S. employment or payroll, but you second them to your organization that is set up outside of the U.S. And so then you have an arrangement between your U.S. NGO and your organization outside of the U.S., pursuant to which they basically second the employee over to that country for a period of time. It addresses a fair number of issues. It allows the employee to keep their benefits. It mitigates and it limits your U.S. NGO to some unpleasantries that they would have otherwise in the jurisdiction outside of the U.S. And quite frankly, you just comply with all of the regular regulations and documentation that you need whenever you have a transaction between your U.S. NGO and your organization outside of the U.S. One other thing, and that goes back to the very beginning of our presentation with respect to, maybe putting your finger or your foot only into the water and not setting up a whole structure or a whole organization in a country because of entry cost and exit cost. One thing we have done for a fair number of NGOs is really kind of having a global employment entity. And the reason why we thought about this is kind of like the following issue. Whenever you set up or whenever you start expanding and having operations in outside of the U.S., you basically send maybe employees there. You start building something up, and as a consequence, your NGO is exposed to all of the local tax and reporting requirements. And it can also be that even though you are a tax-exempt entity in the U.S., you will not be recognized as a tax-exempt entity in that country, and therefore you have to basically are being treated like for-profit entity. Well, the local IRS or the taxing authorities there, they usually then look back up the chain, and wherever the assets and wherever the valuable things are, that's where they would really look at taxing that the NGO, which is kind of like ironic, but that's the way how it works. So what we have done is basically whenever an NGO is not ready to commit to a jurisdiction, what you do, you basically set up a global employment entity, which is more or less just a shell underneath your NGO, and that entity is then the one that is actually sending the employees outside of the US. And what that structure does, it really is more a formal structure, and it doesn't have really any operational impact, but it helps you to mitigate any potential exposure that entity might have in those jurisdictions before you commit. So it's kind of like almost like a shield, and it's a shield that will help you to mitigate liability, and then also in case you actually were to be audited, that you have an argument, and actually a very good argument, that there are actually no assets to be taxed. So,
and then I should add, Friedemann, that in this situation, a single member LLC for federal tax purposes is what we call a disregarded entity, meaning for federal tax exemption purposes, presume most all of your organizations are 501c3s, it's as if the LLC doesn't exist. So for Form 990 reporting purposes and other federal tax purposes, everything gets kind of rolled into your core 501c3 entity. So it has a great benefit in that regard.
No, thanks, Jeff. And this is exactly right, that it's a very formalistic arrangement, but it doesn't really have an impact in the U.S., but it's a very nice shield, because from a non-U.S. perspective, the LLC is actually respected, whereas, as Jeff correctly points out, from a U.S. perspective, it's almost like it doesn't exist. The last slide, a few more items, and just keep that in mind. Whenever you have more than one organization, i.e. you have an organization in the U.S. and you have an organization outside of the U.S., there needs to be some, we call them intercompany arrangement, there needs to be some written agreement put in place whenever you provide services or whatever you do and have a relationship with that entity. It's required by the IRS. It's required by your local taxing jurisdictions. It allows you then to also comply with your transfer pricing regulations, and it avoids actually a potential penalty. So there should be always a written agreement in place whenever you contract or whenever you transact between your U.S. company and your organization outside of the U.S. The last comment is with respect to foreign currency control issues. So we are seeing this as an issue, especially right now in China, that China has become much more restrictive with letting cash getting outside of China, and also to exchange RMB into USD. So this is also a kind of like a trap for the unwary. So whenever you go into jurisdictions where there's a foreign currency control issue, it's usually also a timing issue. So it usually takes time to actually get cash in and out of those countries, whether it's China or Brazil, to name just a couple. So I will conclude with that.